So my name is Katharina Pistor. I'm a teacher at Columbia Law School. I've been there for many years. My interests are actually in law and development. So the previous session was really very interesting for me. I teach corporations, I teach law and finance. I published a book last year, which is called The Code of Capital, How the Law Creates Wealth and Inequalities. Thank you, Michael. And John told me that I should make advertisement for it. I should say that it's coming out as a paperback in a few weeks. So wait if you haven't bought it yet. So the speaker today is Nicolas Véran, who is a senior fellow at Bruegel and the Peterson Institute for International Economics in Washington. He has done a lot of research and policy work on financial systems, financial reforms around the world, including global financial regulation, and in the EU. And then Michael Barr. I think, Michael, I've known you for many, many years, certainly when you were still a law professor at Michigan, if not earlier. And but he's now the dean of the Gerald Ford School of Public Policy at Michigan University, still affiliated with the law school, of course, and has also a stint with the Treasury in regulatory financial reform in the United States. So I think these are two great speakers here to think about regulation. So Nicolas, the floor is yours, and you have 20 minutes. I'll keep the time.
Thank you, and I think the previous panel set high standards in terms of timekeeping. Do you all see my slides? Yes. Okay, so let me have them full screen. In terms of the usual introductions and disclosures, sorry, I have to mention not only Bruegel and the Peterson Institute, as you kindly did, Katharina, but also the fact that I'm a non-executive independent director at the Global Trade Repository arm of DTCC, that's a mouthful, and also an investor in new fund, private equity fund, which is venture capital, which is run by my brother, who also attended some of yesterday's sessions. So you know all my different interests, even so I don't use them as conflicts. Especially DTCC is relevant because I'll come back to issues that are germane to it. Also in the disclaimer department, this is a presentation about that looks at the global financial system and what's important for the global financial system. So with contrast to the previous session, de facto it's an advanced country and China perspective. It's really not about regulation in poor countries. Also, it doesn't go into central bank digital currencies by choice, and also not on tax issues, which are very important when we think of fintech, but which are on purpose left outside of my scope. So with all this in mind, it's early days. When you take that perspective, fintech is really small outside of China, and China is different anyway. There's been a lot of hype, of course, about especially Bitcoin, DLT, Libra, but if you look at the real world footprint of all this, again, with a very important exception of China, it doesn't feature in the global financial system because it's arguably bigger in developing countries, as we heard, but they're small in global finance. Also, we don't have much of a track record in terms of the impact of fintech-centric legislation. Probably the best example is the Second Payment Services Directives, PSD2, in the EU, which is called open banking in the UK. The UK has added some features of their own. In the UK, it's been enforced since early 2018. In other member states of the European Union a bit later. But I think there isn't yet very good research on how that has played out in practice. And the same is true of other projects or early examples of fintech-centric legislation. So I think we're really at the early phase of discovery also in terms of research and analytical frameworks, including policy frameworks. I think everybody is still trying to find the right way to think about it. The BIS has made interesting contributions, Yun Shin, sorry, and also what Benoit is doing that he gave us a sense of yesterday, but all this is very, very early and typically started in the last 2 years. So is finance different from the rest of the debate about tech and big tech and platforms? By the way, in terms of semantics, I use big tech the way other people in this group use platforms. It's really a synonymous label, I think. Yes, finance is different because of financial stability. And financial stability is something that's unique to the financial sector. You don't have the same kind of concerns in other sectors, including those covered so far by platforms outside of China. So for example, if you think of cloud services, I think it's fair to say that cloud services present a unique challenge in fintech, in finance, more generally. I don't know whether you include the provision of of cloud services to big banks as fintech. I think it's a related concern, certainly, and one which has been explored to a very little extent so far. I think there are equivalent concerns in critical infrastructure, for example, energy infrastructure, but I think really the question, which is really about, if there is a big outage in a big cloud service provider, what does that mean for society and specifically for the financial sector, is something that, that has unique dimensions when you think about finance. But at the same time, fintech is tech, financial data is data, and therefore there are concerns which have been raised in tech matters that are relevant for finance as well. Typically concern about the privacy, the ownership, the integrity of data. So finance is not an island compared to the things covered by GDPR, for example, in Europe. There are, of course, additional layers in finance, for example, anti-money laundering, etc., which suggests that financial houses probably have their tech houses, their data houses, sorry, more in order than other parts of the economy. So, for example, GDPR was comparatively easy to implement in finance. I quote a report by Deloitte. And conversely, there might be inspiration for non-financial data regulation from experiences that are unique to financial regulation. For example, open banking. I think some people are looking at lessons from that early experience for other parts of the data regulation world. Even so, of course, financial data is different from other data in terms of content. For example, if you think of, I don't know, child porn, political content, election manipulation, etc. In comparison, financial data is tame. It's only numbers, no images, no videos, and therefore, at least so far, and therefore not necessarily the same challenges. Now, one big question is whether what I called here big fintech, which is really if big tech goes into finance, if platforms go into finance, as we see in China, is that just too big? So there are already big concerns about big finance, about big tech. If you bring them all together, is that just too much, both from a risk perspective and also from a political economy perspective? I'll come back to that in a moment. The new tech is disrupting regulators, not just business. And I'll spend a few minutes on this because it's kind of the flip side of the equation. He didn't cover it yesterday, but Benoit had has a good presentation about regtech and subtech and how the supervisory world is being disrupted, which essentially is his job as the head of the BIS Innovation Hub to help supervisors cope with that disruption. And there are many dimensions to this. One is that regulating and supervising fintech startups is really different from regulating and supervising incumbents, which is the normal job of financial authorities. Your typical bank, more so in Europe than in the US, more so in the US than in Asia, but your typical bank is, several decades old, if not centuries. Some European banks will go beyond the 500 years age limit. So the startup culture is difficult to assimilate for regulators. Also, regulatory requirements are difficult to assimilate for startups. And we've seen that in a lot of examples. I'll come back to this when talking about Wirecard, which may be a non-typical example in a minute. One aspect of this, of course, is the whole compliance culture, which kind of goes against move fast and break things. But it's also about the pace of development. For example, regulators have thought that a good early response to that challenge was to establish sandboxes. But a sandbox is almost contradictory. The philosophy of the regulatory sandbox is almost contradictory to the thinking about hyper-fast scalability and the notion that no matter how big your sandbox is, you will outgrow it very fast if you're successful. The typical example here being Chinese P2P, which was a kind of sandbox, even though they didn't use that vocabulary. The Chinese authorities said, you know, P2P sounds like a good idea to shake up the system a bit, so let's let them grow in it. And if you keep the sandbox metaphor, it has grown very fast into probably bigger than the Gobi Desert, with you know, billions of Chinese savers losing their savings when the P2P bubble burst. Another challenge is to work with data. Regulators may be helped by, you know, fancy regtech and subtech innovations, but their data culture is generally lagging behind. I have tried to see how that was playing out in terms of the internal organization of, for example, big central banks. The Fed had the chief data officer for a while. The ECB has started to do that. Apparently, this didn't play out very well internally, but I haven't done the whole assessment. I don't know what the latest status is for this, but suffice to say that big data kind of analysis is, you know, the authorities are trying to catch up with what can be done with analytics and all of that kind of things, but I think they're behind the curve, and I'll give an example which is related to my experience at DTCC trade repository in less than a minute.
I just want to give you a 10-minute heads up.
Yeah, thank you. Also, of course, fintechs escape or withdraw the sectoral categories on which regulation is often premised. So if you take the US, but also many other jurisdictions, you have different silos for banks, for insurance, for broker-dealers, for fund managers, for payment services providers. And these silos are obviously being disrupted or even completely demolished by fintech. Similarly, fintech hop across borders more easily than traditional players. Some of that is a race to the top, some of it is a race to the bottom, but the notion of geographical jurisdiction is challenged by many of those models. And fintech have other regulators and financial regulators. So typically data authorities, also competition authorities when they become big, interfere with the financial regulation in a way that may or may not be familiar from the previous experience of financial supervisors and regulators. So this leads to new kind of turf conflicts. The regulation of financial data by non-financial data regulators is a particularly sensitive area on which financial authorities have been, I think, reasonably successful so far to defend their turf against incursions from the likes of, you know, the European Data Protection Agency and the likes. But I think this turf war is not over, even though some skirmishes or battles have already been fought. So I already alluded to that. None of this is completely unprecedented. Financial authorities have had to adopt new ways of regulated newcomers and redraw their boundaries in several ways in the past. And you can see parallels in past history to each of the bullet points in this slide. But it's all happening much faster now. And I think in a way that could easily be disruptive, even so I don't think it has been so far. So I'll move on to two cautionary tales briefly before going to policy conclusions. The first one is indeed the mandate to report derivatives trade. Some of you are probably not familiar with this, but the G20 in its wisdom in 2009 in the London and Pittsburgh summits decided that all derivatives trade should be reported to central trade repositories. And indeed, the one I'm an independent board member of is one of those trade repositories. It's not DTCC, the central counterparty. It's 100% owned operation of DTCC, which is several legal entities, but which deals only with what they call now repository and derivative services. And there was a successful precedent with CDS, which had been initiated very much by the New York Fed. The whole story is in Tim Geithner's book, Stress Test, in 2003, if I remember correctly. And it's a great proposition. It's not very difficult from a technological or operational perspective. So all derivatives trades are reported, and you have them all in one place, and you can look at exposures and see the exposures building up almost in real time. And this is great to monitor the financial system and to prevent financial stability threatening concentrations and the like. So the G20 mandate made a lot of sense. It was a good idea. And I think less controversial than other things that they did, like central clearing of over-the-counter derivatives. Now, 11 years on, it's a failure, which the politically correct way or diplomatically correct way of saying this is that the vision remains unfulfilled. The reason for that is really regulatory fragmentation, the fact that different authorities have imposed different data formats and things and wanted different players to do it and didn't want a single global infrastructure in practice, even so they paid lip service to the vision, but also the lagging data culture. Here is a very blunt quote from Benoit, which he made publicly in a Peterson event series that, we didn't have the technology, we the financial authorities, this is said from his perch at the BIS, didn't have the technology on the supervisory side. I think this is blunt enough. My second cautionary tale is Wirecard, because why not Wirecard? It's here also it's early days, the judicial saga is still unfolding. Some people are still on the move. We don't know if they're alive or dead. It's very vivid. But what is clear is that there was a comprehensive oversight failure along several dimensions. And some of them are more relevant to fintech regulatory debates than others. In a way, the more mundane one, which is also the more established, it's the first, which is this was a very old style failure of corporate reporting, auditing, public enforcement of accounting standards, and the like. So the culprits here are BaFin in its capacity of corporate reporting supervisor and the auditors and whoever is supervising auditors in Germany, if there is any such thing. Very traditional, old style. But there are also questions about fintech and money laundering, fintech and payment system supervision, also to a limited extent, even so that's been a defensive argument of BaFin, the German regulator, banking supervision. And I think as we learn more about the story, beyond the initial journalistic disclosures, I think there will be interesting lessons for fintech regulation here. One that already jumps out of the case is what I call fintech nationalism here, that everybody in Germany wanted Wirecard to succeed because it was a kind of fancy, shiny fintech champion of Germany, and that included the regulatory authorities, BaFin in that case mostly, and also the finance ministry apparently, maybe even the chancellor's office. So I think there are many interesting lessons here in terms of what may work or not in regulation, especially in the current context of geographically fragmented regulation. So let me move to my last slide, which is the policy takeaways. I put a question mark on the title because I think it's still very early. Regulation moves slowly, even for fintech. So we still don't know on many things. I think this justifies practical approaches based on observation. Anyway, we know that nobody has a fully holistic model for financial stability. So I think everybody should be humble. I mean, some scholars, for example, Saule Omarova, have suggested that the disruptive nature of fintech should make us move towards financial product licensing, right? I mean, no longer, contractual freedom. Financial products, because they are so scalable and they can be so disruptive, they should be licensed. I think that's slightly overambitious in terms of the ability of authorities to understand what will be the consequences of new financial products. And I think the presentation we just had on developing economies, poor countries, illustrates that. Observation is important to understand how this thing plays out. What the authorities should do is being reactive and being able to react quickly if a new financial product becomes threatening for their mandate. I think authorities really need to raise their game in terms of systemic monitoring, and especially holistic, including non-banks, including new players like fintech. And here, the story I gave about trade reporting is really depressing. But the notion that authorities should build, if possible, a real-time global map of what's happening in the financial system is really compelling. And I don't think this is utopian. It raises governance issues, but not operational or technological no-goes. I think financial authorities need to engage more than their comfort zone suggests with non-financial policy reform discussions, projects, and also authorities. So, for example, the dialogue with competition authorities is extremely important, I think, but also with data protection authorities, as I mentioned. And one possible option on which I haven't formed a firm view, but I think certainly needs discussion, is whether there should be a separation of platforms and finance, or big tech and finance, the same way there's a separation of banking and commerce in the US, just because having them all together conglomerated is too much concentration of market power, political power, and risk. Finally, last but not least, I think fintech should accelerate discussions about supervisory architecture in individual jurisdictions and globally. In individual jurisdictions, that's basically the debate about Twin Peaks. Should there be a single approach for prudential, a single approach, by which I mean basically a single regulator for conduct? I think fintech reinforces the case for Twin Peak supervisory architectures. And in a way, we have a little bit of that in both the US, Europe, and Japan, for example, and also increasingly China. I know I'm past my time, so I'll conclude shortly. But fintech could be an accelerator. Internationally, if not globally, I think there is a very strong case for supranational experimentation of supervisions that would work across borders for fintech and other models, not for all financial firms, certainly not for banks. But I think the experience, for example, in the European Union suggests that supranational supervision is less utopian than it sounds. And I think fintech may accelerate the moment when it becomes relevant beyond the European Union to supervise at least some limited segments of the marketplace, trade repositories, again, being one possibility, credit rating agencies, other models that are fintech specific, because otherwise it's just impossible to supervise effectively. Thank you very much.
Great, thank you so much. So Michael Barr is next. I'm not sure whether you also have PowerPoints to share.
No, I'm gonna spare you all PowerPoints and just talk.
Okay.
Thank you very much for having me, and Nicola. I really enjoyed the presentation, as I always do with your work. So delightful to see you again. I thought I would try and do three quick things. One is to just provide a little bit of an overall framework. A second thing is to talk about what are the kinds of things we want, like what are the outcomes we want, and then what are our fears. Just in terms of the overall frame, I think it's helpful, just to, this is, I think, implicit in the way, Nicola, you were talking about this, but, think about the problem of regulation in fintech as part of the really well-discussed problem of innovation and regulation more generally. And we know that there are cycles of innovation, and there are cycles of regulatory response to that innovation. And regulators are, I think, invariably playing catch up behind, even if we give them fancy new tools. So we know that regulators are going to be behind. So what does that mean about the kinds of regulation that we want regulators to think about? And second, we know there's a basic problem that regulators face of wanting to take action to prevent some harm or facilitate some good. But they're also operating against an existing landscape of market players. And it's very, very easy for regulators inadvertently or on purpose to lock in the dominant incumbents. That is a primary result of lots of regulation. And so you're just always worried that you're going to lock in dinosaur technology, you're going to lock in monopoly power on the one hand, and on the other hand, that you're going to act too late, you're going to miss some big risk in the market, and you're not going to do it right. So regulators are in this is true not just in this space, but just in the space of innovation. I think that's the basic framework. So what kinds of things do we want? You know, we want regulation to help foster various kinds of things in the market, and to, this is my third topic, prevent some harm. So what kinds of things do we want? Let's think about some particular examples. I think it's very easy to get caught up in like the blockchain hype or the fintech label hype and forget, you know, what are the use cases that we think are actually going to improve outcomes for human beings and businesses, which is presumably the goal of developing new products and services. So one thing we know is useful to people but has some risks are real-time payments. We know that people and small businesses suffer a lot of harm by not having access to their funds right away. They get overdraft fees, they get insufficient fund fees, they can't feed their children. And there are all kinds of delays we have in our payment system domestically within countries and certainly internationally that cause harm because of frictions in the payment system. So it seems like that is a targeted goal that whatever fancy arrangement you want to put together to solve it, we should be focused on. And it's a goal that blockchain might be useful for, but so could cloud computing, so could changes to the correspondent banking system. So we really need to focus on what the outcome is we're trying to get. I think a second big kind of goal is empowering consumers. People have different, versions of what they mean by that, and some flavors are more libertarian and other flavors are more protection oriented. But basically the idea that we want consumers and others to be able to have more control over their own financial lives with less disruption. And there are lots of many ways of doing that. I think, one that Nicola pointed out is the idea of open banking. The basic idea there is that a consumer has a better access to and better control over one's own financial data, and can use that data to do things like dump a bank that's treating them badly. If you have better access to your data, you can port your bank account information from one bank to another. That will increase switching improves competition. Improved competition presumably has an effect on pricing, especially contingent pricing, after the fact pricing, as opposed to upfront. So that's a second big area. Portability is obviously, huge. It affects not only the financial sector, but also health and big tech, as you were describing, but I think that's an important area. A third area that might think about is reducing frictions in the system beyond payments. We talked briefly about AML, money laundering, anti-terrorist financing. There's a lot of sand in the gears that is spent in that space that isn't very good at catching bad guys and costs a lot in terms of access. So it's kind of low-hanging fruit for improvements in the global regulatory architecture. What are we afraid of? Let's pick a few big examples. One of them obviously is financial stability. And there the big issue is replicating a bank outside of the banking charter, or put in a different way, a private money creation without appropriate government backing. And as I mentioned briefly in an intervention yesterday, I think that's the big, that's the big issue to worry about, is private money creation that pretends that it's fully private and operates that way just fine in normal times. But in crisis times, inevitably requires government intervention. And then we all pay for it. And if it's on the scale of something like Libra, it's off the charts. But even a very large financial institution, a very large telecom, whatever the provider is. And so, our financial stability concern, I think, ought to be focused on how not to replicate the problems that we've seen for centuries with private money creation. So that's, I think, a big concern. And the last concern I'll mention is really about integrity. And many people are talking about it as trust, which I think is another great word for it yesterday and maybe a little bit this morning. How do we ensure that there is trust and integrity in the market? Because whatever we think about technological solutions, I agree with those who said yesterday, they're not a substitute for trust. And trust is really required. And a number of fintech applications pose significant issues for trust. And I'll just mention one that I've been spending a bunch of time and work thinking about with some colleagues in computer science and in finance. And that's high frequency trading markets and the problem of manipulation in high frequency trading markets. You saw this giant settlement with JP Morgan Chase for spoofing the markets. The thing that's amazing about these spoofing cases is that they're only really uncovered after years and years, and because there's overwhelming physical evidence of intentional wrongdoing. So it's not the case that the regulators are super on top of this, they've got a hold of the data and they've figured it out. No, it's people screaming over email that they're violating the law repeatedly for years, and then they get caught. So there's a real issue in regulators being behind the eight ball in ensuring integrity in our markets, and integrity, I think, is important for trust.